Today we're taking a look at an alternate version of Quick Study 11-16 from page 518 of the textbook on Chapter 11's Reporting and Analyzing Equity. This quick study is going to take a look at accounting for cash dividends. It says there are three transactions that have happened here, and we're going to be needing to prepare entries to record the above transactions for Emerson Corporation. The first transaction was on July 15th. The company declared a cash dividend payable to common stockholders for $163,000. In this transaction, the moment the board of directors declares the stock dividend, the company has become liable for that amount, and thus retained earnings are affected on that date of declaration. So on the date of declaration, July 15th, retained earnings are lowered by the amount of the stock dividend of $163,000. And to lower retained earnings, we debit retained earnings. Remember, retained earnings are on the right-hand side of the balance sheet, and right-hand accounts have a normal right-hand side balance. To lower something with a right-hand side balance or a credit balance, we give it a left-hand entry or a debit entry. Thus, we debit retained earnings to lower retained earnings. We're not paying out the dividends just yet. The dividends will be paid out in the future. We're just making the declaration on July 15th. So the offsetting entry is a payable account called Common Stock Dividend Payable in the amount of $163,000. The next transaction is on August the 15th. It reads, "This is the date of record. Date of record is August the 15th for cash dividend declared on July 15th. So when the board of directors declared that cash dividend on July 15th, they said everybody who owns stock by August the 15th will be entitled to share in this dividend. So on August the 15th, when that rolls around, there is no entry required. There's no formal entry because the company would assemble a payee list for the dividend as of October the 15th for all shareholders on record at that time. The next transaction, August the 31st, the company paid the dividend declared on July 15th. Now the shareholders are actually getting their money. So that common dividend payable, that IOU called common dividend payable that had a credit of $163,000, now that's going to go away. So how do we get rid of a $163,000 credit? We do a $163,000 debit. And now the shareholders are actually getting cash, so the company's cash reserves are going to be lowered by the amount of the dividend. Since cash is an asset, assets have normal debit balances, we lower cash with a credit entry of $163,000.